When looking at accounting entries, it is important that these entries are as accurate and up-to-date as possible so that the financial reports are correct when finalized. An efficient and necessary way of doing this is by making changes to the journal through what is called an adjusting entry. An adjusting entry is simply a new entry that adjusts account balances. There are a couple of reasons that adjusting entries are used. A company may have made mistakes in preparing journal entries in the past, or, more likely however, is to record revenues and expenses that have been earned and incurred, but not actually recorded. So let's take a look at the situations where adjusting entries are used. The first is when a company will receive cash before they earn the revenue. For example, when you book a flight in advance, the company will receive their cash before they actually complete the service. Now, the company can't just put it down as revenue because they haven't provided the service, so rather, it is put down as deferred revenue. This revenue hasn't actually been earned, so it is recorded as a liability. An adjusting entry is then used to turn the liability into revenue through debiting cash and crediting the deferred revenue. The second scenario is when a company completes a service but is still yet to be paid, which is known as accrued revenue. It is often required that a business will have to finalize financial statements before this accrued revenue is paid to them. However, it is still required that the revenue is recorded in the period it was earned. This is commonly done by debiting accounts receivable, the asset, and crediting the product revenue. The adjustment to this entry is done when the cash is received, simply by debiting the cash and crediting the accounts receivable. The third scenario is when the business pays cash before they incur an expense. When a company pays for a resource before it is consumed, the business has a deferred expense. This term is used as the expense only occurs when the business actually consumes the resource. So, in the meantime, it is recorded as an asset, and then when the asset starts being consumed, the expense is debited and the asset is credited. The final scenario is an accrued expense, with the most common example of this being employees' salaries. An accrued expense is an expense that is incurred but paid for later. There are issues that arise when the financial reports need to be finalized. Due to the accrual basis requiring that expenses are written in the period in which they occur, it is often required that the expenses are debited and the equity is credited. The adjusting entry then can be made once the expense is paid for by debiting the equity and crediting the cash.